everyone, welcome. You're watching Closing Trades right here on Nifty now, and you are catching us live from SBI Live Studios and taking a look at what the markets are up to. So we are seen to be consolidating in quite a range for Nifty as well as Bank Nifty. But the fact of the matter is that for now, the breadth of the market is not that concerning, and along with that, it's a lot of sector churning that is still underway. Top of the list is actually Jio Finance, which is the top gainer on the Nifty 50 side, followed by Eternal, Bajaj Finance, HUL, L&T. These are some of your movers, but on the flip side, it's autos that are seen to be in a bit of a reverse gear. Like we have been flagging off for the past 2 to 3 days, autos were taking a little bit easy, and it's M&M now that is the top drag on the Nifty 50. Stocks like Asian Paint, Shriram Finance, Cipla, Dr. Reddy's, the list is long, wherein we are seeing a bit of a profit booking. We can't call anything that is looking concerning right now, given the fact that on majority of the counters the decline is not over 1%. But other than that, select counters within the telecom space, they are buzzing away, like Vodafone Idea, Industar, they are doing well. And add to that list is select cap good companies as well, because Siemens, ABB, they are doing pretty well even in this market. And Snehi, we can't take our eyes off from the real estate pack as well, because after so many days I can see stocks like Prestige, DLF, they are also making a very smart comeback.
Absolutely, Shrishti. You know, it feels like I finally have some sectors to talk about, because my sectors are finally doing well, the ones that I track. FMCG had its run when the GST announcement came, and the other one that I track closely, real estate, we finally have some exuberance being seen in that sector, and that has been single-handedly carried out by Anantraj. Let's pull up the stock of Anantraj and see what that stock is up to, because you also have reports coming in that the government is suggesting a tax break on data centers, at least for the next 20 years. So on the back of that, Anantraj holding up very smartly, a 12.5% intraday uptick coming in on the stock. But it's not only Anantraj, it's also some other names that have exposure to the Noida market, because we've heard that the UP government is now scrapping its old real estate rules, and on the back of that, the limitations of building heights in Uttar Pradesh will also be rejigged and reworked. Positive for a name like Max Estates that has significant presence over there. Other than that, some players of the south, you have Prestige, Brigade, Sobha, all of them doing well. DLF from the north, you have Phoenix, Godrej in Mumbai doing very well, as is a Raymond. Brigade also doing very well from the south, and Oberoi Realty in Mumbai also holding up pretty smartly. So pan-India, you have a lot of these real estate players that are doing very well. Other than that, if you see the next best sector today, that's PSU banks, UCO, Canara, IOB, PNB, Maharashtra Bank, Central Bank, all of them are doing very well for themselves. Another sector that we flagged off in the morning and continues to hold on to some very smart gains is the entire railway pack. Let's pull up a RailTel, that's up 6%, Ircon International up 6%, you have RVNL that is also holding up very well, as is the case with ITI. All of them are looking very good in trade today. So that is basically the roundup of what's been happening in the market so far, last 1 hour of trade. Let's see if we're able to hold on to all of these levels that we're seeing on the railway stocks and in the market otherwise, because if you take a look at the Nifty, we've slipped into the red, 0.1% lower, but not very far from the 25,100 mark. To discuss this and more, let's welcome on board Daljit Kohli, Head of Equity at Roha Asset Managers LLP, and we also have Kunal, who's joining us in the studio. Good afternoon to both you gentlemen. Kunal, let's begin with you, because the kind of moves that we're seeing in the market today, once again range bound, but 25,000 seems like it's going to be here to stay. What is your take on 25,100? Because we have not steered too far away from that.
Good afternoon. So yeah, I think it's a okay day for the indices, more of consolidation, and you know it's a natural way of consolidation, because on two fronts. One is that over the last few days we've seen almost like a 4 or 5 consecutive days where the index has closed onto the positive territory. So the momentum was just about getting along for the indices. We managed to break past about the 25,000 mark. So that was another important trigger for the index over the very short term. But the second and the most important part is, you know, when you look at this in the context of the last 1 month of price action, we were forming a double bottom for the Nifty chart. The resistance, so the first immediate resistance for the Nifty is just around the 25,100 levels. So it becomes an obvious zone for the index to just about take a pause for a couple of days before it starts to get back into retest of the upper end of this resistances. The only important factor for a short-term trade to watch out for is that generally if the index consolidates at the first important resistance point, we should not see a change of stance from the option writers, like what we've seen, for example, from the put writers, from the call writers, we've seen now stance changing to put writers. That should not reverse back into the call writers, which means net we should hold on to that 25,000 mark for the next couple of days. If we do that, then I think there could be one more round of a breakout on the upside for the index. So the view remains positive till the time we trade above and close above 25,000 on the Nifty spot.
All right, so on the spot levels, watch out for 25,000. That could be a make or break level for the markets, but the bias remains to be on the positive side. But Daljit, hi, good afternoon and good to be speaking with you. Firstly, help us understand what is your current take on the markets, because everybody has been calling out for that this particular year is the time to be very, very selective in the markets. So what are you making out of it? A lot of these fresh triggers have also come out for the market of late.
Good afternoon.
Good afternoon.
Thanks for having me on your show. See, I think we are not that cautious. In fact, we are calling out that all this talk about uncertainty from global and all of that will probably take a little backseat. We have seen historical also that whenever these cycles turn, initially there is always a suspicion. People take time to understand that whether this is going to sustain or not, how this will work out, and people want to see the numbers. No, so but markets by nature are that if you wait for the numbers, then it is probably too late. So in fact, we are positioned with this view that consumption is going to play a good role there, and therefore most of our portfolio stocks are aligned to that. It is across the spectrum, so right from small appliances company to the high-end luxury car sellers also. So that's the way of dispersion within this sector. So that's one area where we are thinking that probably we'll see good numbers. Second would be the agrochemicals and chemical cycle. Again, we met a lot of companies in this period for agrochemicals especially, and we are of the understanding that this cycle, which was 3-4 years, too much of inventory stocking, etc., and which had led to price crash, that is probably now coming to an end. So most of our companies are positioned to get the benefit. Volumes have already started coming in, but pricing is still elusive. So maybe in next few months we should see that also falling off. So that's why we say that this sector probably again will see good numbers coming in.
Okay, so those are some of the sectors that Daljit believes will benefit from the entire rationalization program, and some sectors that he's liking right now. Kunal and Daljit, stay on with us. We'll slip into a very short break and talk more about the markets and the day we've seen so far on the other side. Live from the SBI Live studio, let's keep the conversation going with Daljit and Kunal about where we think the markets are headed. Kunal, what is your take on some spaces that we've seen some good moves coming in today? You know, as was the case with IT last week, we saw a couple of days of up move coming in and it got the street excited, but it all fizzled out. Do you think that story could repeat with real estate? Because today is the first day of gains coming in for this segment after a very long time. So it could be a lot of time-based, up move as well. But do you think this is here to stay, or do you think this is largely news-based and could fizzle out by tomorrow or day after?
I think it's a very good question, and I believe in the context of the market so far. So, let's first understand over the last, 1 week, 10 days of the setup where the Nifty's moved up higher. We've gone through a churn across various sectors, phase by phase. Initially it started off with auto stocks doing pretty well. Then there was a good recovery of, FMCG stocks led by, recovery from the pharma pack, then private sector banking names, PSU banking stocks, defense names, etc. So the only catch over here was, a sector like real estate, which was a huge underperformer over the last 2 months or so. Many of the stocks within the real estate pack, I think, had corrected more than 10% to 20% in that kind of a time span. So it was obvious that there's bound to be a point where the realty pack would also get into a breakout mode. I think today, in the back of this news flow trigger, etc., there could be a point which could be made that we could now be looking at a short covering spree across many of the real estate stocks. And even if that happens, even if assuming that this could be a short-lived momentum upside, it would probably just about play out like how the IT stocks and the IT rally played out, where you would see at least 2-3 days of a very strong surge of momentum, where the large cap names probably moved up higher by 5% to 10% in a very short span of time. So I would probably expect something similar happening for the real estate pack. These stocks are up on an average 2%, 3% so far. But I believe that if you look at in this, say, at least in the context of the next 3 to 4 days, I would look at a further 5% swing upside for many of the real estate names.
All right, so that's the take coming in on the real estate counters. But Daljeet, this whole discussion, or rather, some reports highlighting that data centers can be given some bit of a tax relief, and that could be for as long as 20 years. What are your thoughts on that? And yes, Anantraj is one of the counters that is seen to be buzzing. But along with that, help us understand any other segment where you believe that one can really look at. If you can talk stocks, then that'll be great. If not, then what are your thoughts on this overall news piece?
You see, this story is very long term. There is no doubt about it. There is a big potential here, and data centers as a theme will play out for a very, very long time because it has just started. No, the government is making rules that most of these companies will have to keep their data in country. Reliance has just mentioned in their AGM they are putting up a big data center, gigafactory kind of thing there in Jamnagar. So there is a huge potential for this as such. But how it will play out and how long it will take, we will have to see. Now, Anandraj is the nearest right now moving because that's the prima facie, the first beneficiary. We don't have any position in this company as a disclosure. But definitely, as a theme, this is going to work. Now, one thing we have to be cautious is when there is a fad for a theme, you normally end up paying too much of valuation. No? And for investment and portfolio managers like us, valuation is a very important criteria. So we tend to avoid when things are in fashion, when things are out of the fashion, when sector or theme, when most people are not looking at that, that is the time when we look at them. So probably we will, as of now, stay out of this theme, let the valuations cool down, let the numbers come in, more clarity on this policy, etc., should come in, then we will probably take a call. But there's definitely the theme is going to stay there for a very long time. You were just talking about another sector on real estate. So our take there is probably instead of playing real estate as of now, cement could be a good sector to play as at this point of time. We normally juggle between these two because both of them are complementary. So if you say that, see, in real estate, the problem is that a lot of top tier cities, the price per square feet has already reached peak. So there is very little scope for further price movement. Now it will be only on the volume growth which will come. And many cycle of this real estate has also been going on for last 3-4 years. So what we believe is that probably now it's better to play this thing through cement, where there is a lot of consolidation has happened. Many companies, there is price discipline. If you see in East, they have raised the prices for last 6-7 months and they've stayed put there. In North, some movement is there in the pricing. So while Q2 numbers will be slightly lower because of the extended monsoon, but that can give a good opportunity to enter in this sector for anybody who's looking for a good long-term investment in cement. So that's one area, again, we are looking very positive.
Okay, thanks for that view coming in, Daljit. Let's get stock specific now and talk about the stock of KRBL, one of the biggest losers on the street today, and the stock has come crashing down after independent director Anil Kumar Chaudhary has resigned with immediate effect, citing governance concerns. Before we go across and listen into the management statement, we have Varun standing by with more details on this, what went wrong, and immediately after that, we listen to the management that came first on ET Now with their clarification on what went through with their board meeting and what are the steps going ahead.
Well, so Mr. Anil Kumar Chaudhary, the independent director of KRBL, has resigned from the company, and the news of the resignation actually came on 9th of September. But the reason behind the resignation has now been disclosed, and the reason actually raises red flag on the working of the management and also certain corporate governance issues. Now, in his letter to the board, Mr. Anil Kumar Chaudhary has written that he believes that effective governance and truly independent oversight are essential ingredients to safeguard the stakeholders' interest, and he finds that the prevailing dynamics of the board to be inconsistent with this principle. Also, there are several matters which he has actually raised, but there was no resolution for this matter. Some of the matters which he has actually highlighted are inconsistency in the recordings of the minutes of the board of the committee, also instances of information being withheld impacting the informed decision making. Also, there was some unjust write-off of certain export receivables without adequate deliberation. There was also concerns regarding the CSR funds. Also, there were significant changes to the object clause undertaken without comprehensive discussion. Also, he has written that there were undue interference by the invitees in the proceedings of the board and the committee meetings. So, he has raised several issues, but they were not actually addressed. And he says, in such an operating environment where the dissent is surpassed or sidelined, remaining on the board would not be appropriate, and that's the reason he has actually resigned from the board or from the independent director. So the news of the resignation actually came on 9th of September, but the reason behind the resignation, the letter behind the resignation has now been disclosed, and that actually raises red flag on the way the management has been working or several corporate governance issues there in KRBL, and that's the reason after this letter coming in public, you are seeing that the stock is actually down by around 9 to 10% in today's trading session.
We know about his resignation, and we had independent directors meeting also, as well as the board meeting as well. And it is just about half an hour ago only it got finished. And we have taken a view that we should get everything got audited and vetted whatever he has said. And I think so. Once it is vetted and when it is certified, then people will come to know what is correct and what is wrong. According to ma'am, when a man becomes an hostile, then it will not be proper for me to answer any of the questions. The board consists of 4 independent directors. Out of one was Mr. Anil Chaudhary. So alone, what Anil Chaudhary is saying is cannot be taken as a guarantee. So let the audit committee take its own course, and I think so the facts will come before you.
All right, so that was the management of KRBL talking to us exclusively, but post that clarification as well, no recovery from the day's lowest point is what we have seen on the stock price. But moving on to another news, it was a stellar week for the primary markets with investors rushing in to subscribe to the likes of Urban Company, Dev Accelerator and Shringar. In fact, the demand was so high that the beauty services platform player was booked more than 100x, the highest subscription any issue has seen this year. Is the IPO rush here to stay? That's the question that we are asking. So let's go across to Sharad, who is standing by with the trends that we have seen in the past. Sharad.
Well, yes, primary markets is booming as you compare it to a lackluster performance in the secondary markets. Of course, you look at the IPOs last week, look at the subscription numbers. Urban Company going past the 100 times mark, followed by Dev Accelerator and even Shringar, both of them going almost 60 times, and these are large size mainboard IPOs which I'm talking about. Overall, if you look at the listing day gains also, that has been spectacular in 2025. If you look at the names, Highway Infra, that's up 73% on the listing day. Recent listings include Aditya Infotech, Quadrant, GNG Electrics, and even Stallion India, where we saw significant listing day gains coming. That means in good counters, the grey market premium is on the positive side. Now, let's look at the most subscribed IPOs in 2025, and the numbers are huge. Highways Infra, that was 256 times. Indopharm was 159 times. And also interestingly, Stallion India, Standard Glass, Quadrant, all of them going past the 100 times. IPO rush on the D Street, more than 10,000 crore issue size. They are expected to come, and especially in the next 3 to 4 odd months. In the 2025, Tata Capital, LG Electronics, Lenskart, Grow, and even PhonePe will make it to the list. So, of course, large issue sizes are coming, and recently SEBI also eased the minimum public shareholding norms as well. The popular IPOs, the startup IPOs which are expected to be tracked over the next 12 to 18 months, they include PhonePe, Zepto, Boat, Car Dekho, Avance Financial, and also in the list it includes Incred, Payu, Grow, and Physics Wala as well. So a lot of large IPOs, be it the tech IPOs or the non-tech IPOs, are lined up for the next 12 to 18 months. The primary market has heated up in 2025, significant numbers, 56 IPOs already there, and the positive listing, that's the number to look out. 42 of them have seen positive listing as well. So of course, FI interest is also made in the primary markets, and a lot of retail interest is still there in the primary markets, as secondary markets are still in a range-bound move.
Okay, we'll leave it at that, Sharad. And Clearly, Daljit, a lot of action in the primary market, like Sharad was just highlighting. There's, of course, Urban Company, Dev Accelerator, Shringar as well. But just looking at how the listing gains have been in the recent past with Aditya Infotech, Highway Infra, Quadrant Future, Stallion India, etc. Any of the new paper where you think the demand is going to be good and would be on your watch list?
Yes, we are keeping a watch list on these platform companies. So two of them are already listed, and now this third one, which is coming in. We are looking with a very positive view on these things because one, that the addressable markets, as everyone knows, is very, very large. And now that these companies are clear on their profitability path. No, 2 years, 3 years back, when these companies had come, they were more in the air, more like what will happen after 5 years, 10 years, and nothing to worry about profitability. We will just see, we first have to catch the market and all. But now those things have changed, and we have seen that very clear visibly in their all these con calls, etc. When managements are talking about how they will reach that EBITDA number and that cash flow number. So we as a company particularly give a lot of importance to cash flow. And if there is a visibility or trajectory towards that cash flow, then we tend to take positions in them. As a disclosure, as of now, nothing in our portfolio, but we are looking at this positively.
Okay, Daljit, great to have you on the show and sharing your thoughts. We'll take a very quick break. Back with closing trades right here on ET Now, where the closing trades are looking absolutely flat, and it's really been one of those listless Mondays that we've had at our hands. Better a day for the broader end of the market with sporadic moves in an SBI Cards, NHPC, IREDA has dashed up after quite some time, and then Idea is your top mover with a solid 7% off or notch up. Other than that, of course, there is some macro data flashing for you on your screens right now. The trade deficit data, that is, which pretty much seems in line with what the market was penciling in, because it's a $26.1 billion figure that we were anticipating for the month of August. It's largely in line with that. There was, of course, festive gold demand, which was supposed to accrue in. The US tariffs, of course, continue to remain a big overhang and a risk. And this comparable to $27.4 billion on a month-on-month basis, which is for the month of July. That seems pretty much par for the course, and it's likely to come down a little bit lower in the months to come. So that's that. We've seen a little bit of a modest narrowing, if you will, which has been largely driven by the surge in gold demand. Imports nearly doubling despite higher prices. That's the trade deficit, which is currently at $26.49 billion for the month of August. But that said, let's continue our market discussion. Just half an hour to go before we wind up for the day. Ruchit Jain as well is on the show with us, as is Kunal Bothra. But Ruchit, what are the prima facie trends that you're picking up today? Sectorally, it seems to be it's NBFCs and telecom, led by Idea, which is actually holding up. Any trades there?
Yeah, hi, very good afternoon to everyone. Well, I think if you look at the benchmark indices, then we are not in any kind of directional trend as of now. Our markets have seen some consolidation over the last few weeks, which seems more of a time-wise corrective phase. And we believe that until that 25,150 hurdle is surpassed, this time-wise could tend to continue going ahead. But the broader markets are doing well. We can see that on Friday's session, it was the defense space and the metal space which were doing good. Today, we can see some good gains coming in from the sectors such as realty is there, NBFCs is there. So I think it's more of a sectoral rotation that we can see in the market. One needs to figure out which sector is working on which particular day and participate accordingly. So we are also advising to take more of a sector-specific or a stock-specific approach in such market where the benchmark indices are not showing any kind of signs of a trended phase.
Approach for the market and the market setup going ahead. We also have Anand Tandon, independent analyst, joining us on the show. And Anand, hi, good afternoon, and thanks for your time. Ruchit was talking about how it's time to be sector specific, stock specific, and time to be bottom up. Is that your approach right now? And if so, what's looking good in the market? Because we have seen constant sector churn. What was leading the market last week has become one of the top losers. If you could, put that analogy for a couple of sectors that we've seen. IT, we've seen that case happen with banking and financial in the previous earnings season. What is your take on what could lead the market rally going ahead, if at all? a market rally is something that you're foreseeing?
So the short answer is I'm not forcing a market rally, but that said, the market opens and shuts, and in between it trades, so it will have to do something. And when it doesn't have a direction, what it does is to change a transit between sectors. So the fact that you are seeing sector rotation clearly means that there is no leadership, and the market is somewhat confused as to where you are betting on. The stocks that you would like to bet on have perhaps run up a considerable amount and are factoring in growth rates which are going to be tough to manage. And on the other hand, those which are not doing so well have also gone up perhaps higher than they should have, but will continue to remain. And therefore, assuming that nothing major triggers a reversal in trend, the market will hang around in this area. Now, given that, we are entering into the best phase of the year where the demand will be high and a large part of the consumption growth that happens in the country will happen during the season. And therefore, there will be some news flow which will happen, which will be narratives which will be built up in terms of various sectors doing well and so on. Forgetting that till the first half of the year we have done actually not much. So net, I think I would expect to see this rotation continue, barring, of course, any positive developments in the international markets, removal of tariffs. Given what we know today, this is the best that you should expect.
Okay, that's the best that one should expect. But Kunal, is that what you foresee as well? You think we will continue range bound while the range may pick up a little bit and build on to 25,000, but largely pretty much intact?
I think till the time, so we look at it this way, Aisha, that till the time the sectors start to participate, large cap names start to participate, there is no going back for the index. If we start to see a reversal for many of the sectors which have been huge underperformers, then there is a case of caution for the index. So right
Which is
now,
what, IT, FMCG?
IT, FMCG, Reliance, L&T, these are the stocks which are underperformers. So they've started to show some signs of recovery. We were discussing that the real estate stocks have managed to make a good comeback. There were two of the major underperformers, the IT and the Realty. I think IT has made a good comeback in the last week. Today, real estate stocks are showing that kind of a sign. Now, when you have that phase where the strongest sectors are still looking strong, they are still trading at a much higher price end for those individual large cap names, and then the underperforming sectors one by one make a comeback for themselves. It's just a matter of time that the indices also break past about those boring resistances and get back into that zone of momentum. So I think it's more of wait and watch. I agree that yes, when you have such kind of a vibrant sector zone, you would probably expect that the index picks up momentum pretty quickly. But sometimes I think waiting is something which plays out really well, especially in terms of these kind of setups.
Okay. Anand, just picking up on one of the points that Kunal was just making, the underperforming end of the market. And let's talk about Reliance, because even the AGM takeaways and a hint at geo listing, etc., couldn't really lift the stock up. What triggers do you think will pave the way now for a sort of holdco, if I can call Reliance that, move up?
Well, there are two things. One is that, if Mr. Trump suddenly decides that he loves India and therefore the oil sector, don't forget that Reliance is one of the biggest importers and exporters of Russian oil, and therefore is probably on the trigger of the US regulators and perhaps any other fellows who may decide to put tariffs on India. If that were to go away, there is no doubt you will see a bounce. Now, on the fundamental side, there is a different issue that, you have to look at where the growth is coming from. And clearly, the growth is now not coming from the OMC market. You are actually looking at the consumer side of the business. The telecom business will continue to throw up cash now. I think, we have seen most of the capex behind us. And with a duopoly situation for all practical purposes and a systematic increase in the consumer prices, the cash flows there will start to get released, and that is being deployed on the retail side of the business. So the next big trigger has to be the retail. The retail right now is large, but it is not particularly effective. If they are able to manage their margins so that they bring it up to more regular FMCG and consumer durable levels, I think you can get a next big leg up. And clearly one of those can be the divestment of each of these sectors into more trackable separate companies so that the parameters of each one of them becomes more visible and easier to understand. So I would expect that Reliance will continue to remain, if it remains a holdco, will continue to have some kind of a drag on its performance. But otherwise, as soon as they split it up, you will see individual parts of the business perhaps doing better.
All All right, so that's the take coming in on Reliance. Let's watch out for that. Today we have seen the stock now seem to be recovering from its day's lowest point and trading at the day's highest points rather. But Ruchit, the other pack that is seen to be a little bit under pressure is the auto pack. How do you see the sell-off in the autos that we are seeing? Because autos on the fundamental side, it seems to be now a structural story wherein the recent GST cut can get in the sales for the next 2 to 3 years at least. But technically, do you believe it is offering a good opportunity to enter in select counters?
So I think the overall trend for the auto space still remains positive. It's just that, around this GST news flows, we have already seen a good run up in the Nifty Auto Index. The Nifty Auto Index gave a breakout from its hurdle of 24,200 during August, during mid of August. And just in a time frame of 2 to 3 weeks, the index rallied from 24,000 to about 27,000. So that has been a sharp up move already based on this news flows of GST changes. So I think some profit booking is only been seen since last 3-4 day trading sessions, but this does not seem to be any kind of change in the broader trend, which is still positive. So one should keep a buy on dip approach within the auto space, and any kind of minor declines if we get further from current levels, then no one should look at buying opportunities on those.
Okay, so that's the take on Nifty Auto. Buy on dips is the strategy coming there from Ruchit. But Kunal, just a few minutes ago, like Aisha was flagging off, it's actually the NBFC stocks today that are doing very well. Case in point, you have L&T Finance and Bajaj Finance, both at their fresh all-time highs today. Which one looks better placed on the charts, Kunal? Where would you be placing your bets if you had to pick between these two?
So both of them are completely different charts. Of course, from the same sector. Bajaj Finance is something which is coming back into a recovery. We're discussing this, I think on Itna Swadesh in the morning, that there was a point where Bajaj Finance for the last 5 months, and this is in the month of March, April, May, June, when the markets were going through a good bounce, that stock was a huge underperformer. You look at the candlestick patterns over that kind of a time span, the patterns were just all over the place. The stock was not exhibiting any major kind of a trend. But look at the last 3 weeks, you've seen a very good breakout for Bajaj Finance from I think 870, 880. The stock is back again to those lifetime high levels, breaking past comfortably above the 1,000 mark. Now we compare this with L&T Finance. It's been a very stable chart. I remember that breakout point of 170.75 for L&T Finance, I think around 3 or 6 months back in the month of March, April somewhere. And I think from those levels, we've seen a completely different kind of a chart behavior for L&T Finance. It's been stable. The stock has been consistently showing signs of an uptrend. It tends to just about participate on the way upside when these sectors, when it's, the entire NBFC sector participates. And when you see large cap names underperforming, the stock just goes into a shell and goes into a time-wise correction. So that I believe is a very good quality for in the stock price over the long term. So I think for traders with a dual time frame, so for example, someone is looking at short term, I would recommend Bajaj Finance at current levels also, expecting the stock to move towards the new levels of 1,050 to 1,100 zone. But for L&T Finance, I think this is the big breakout, and specifically on the monthly and the quarterly charts, which means potentially we could be looking at even 280 to 325 plus over the next 12 to 18 months for the stock.
Let's take a very quick break on that note. Yes, some of those stocks are buzzing, but a large part of the market is under pressure and is seeing some profit taking. We'll analyze all of those names after this very short break. Visible at that, of course, there are key pressure points like an M&M, which is down about almost 1.5% in trade. Asian Paints lower by 2%. Bandhan Bank is down 2%. And then there is Biocon and Cipla also from within the pharma pack, which are weighing heavy. Both those stocks are down about 1.5% to about 1.7% now for Biocon. But in the run-up to the GST rate rationalization on the 22nd, Kantar has come up with a note on India's urban FMCG space in the second quarter with a volume growth of around 5% in Q2. Let me take it across to Snehi and get in some details from that report.
Well, yes. So here's the report coming in from Kantar on India Urban. This is only urban specific report coming in for the FMCG pulse in Q2 of calendar year 2025. So watch out for that. They believe that India's MAT, which is MAT, moving annual total, which is the last 12 months of revenue, has grown by more than 5% across categories. And in fact, it's more than 8% across categories. Overall growth of 9.3%. Food, beverage is more than 9%. Dairy at 12%. Home care and personal care at 8.2%. and 8.8% respectively. Now, urban FMCG volume has grown 4.6% in quarter 2 compared to 5.5% year on year. So a little drop in the urban FMCG volumes is what we've seen year on year. They also say that cautious consumer behavior can be seen in discretionary categories, and consumers are opting for smaller pack sizes for milk and coffee. That is their observation. For beverages, the sector has gone from surge to slump. They've recorded only a 2% volume growth compared to a volume growth of 14% on a year-on-year basis. So big drop coming on that front. This is on the back of drop in bottled soft drink volume. MAT over there has also shrunk significantly, and they've seen reduced demand during peak seasons. Lastly, if you take a look at the channels that are dominating the entire FMCG market right now, Kirana stores, they continue to be the king here. They continue to dominate channels in terms of value share. Online channels come next for shopping occasions, and after that it's door-to-door sales as well as chemists. However, if you take a look at the online spends, the money that people are spending on online channels, that has dropped on a year-on-year basis. So that is the roundup coming in from Kantar on the state of FMCG in urban India for quarter 2 calendar year 2025.
All right, thank you so much, Snehi, for getting us all those interesting details indeed. But Anand, just wanted to have your take on the FMCG pack right now, because post 22nd of September, the expectations are that FMCG2 will get a big boost, including the staples. But looking at the valuations, they are not very comfortable right now. What is your own take on the FMCG basket, and anything in particular that is looking good to you? Anand, this question is for you.
You hear me?
Yes, now we can hear you. Please go on.
Yes, I was saying that, you just saw the report from Kantar, which says that the volume growths are between 2 and 5%. Now, if you assume that you're actually growing at 9% as they indicate, it means that we are seeing a price increase of 4%. It leads you to two questions. How are we showing an inflation of 1% if the urban prices are growing by 4%, that too for consumer goods, and that too for fast-moving consumer goods? And the second question is, assuming that actually the inflation figures haven't yet played through in terms of the prices, you should argue that you should see a total revenue growth of shrinking from here further over the next 6 months. And it's very unlikely that you'll buy an extra toothpaste or an extra hair oil just because they have become a little cheaper. So net volume growth not likely to move up dramatically. Prices, if at all, should be falling, and therefore the volume growth will shrink further. In that context, trying to find ways to increase margins will become even more difficult. So you should expect to see the pressure in terms of growth in bottom line continue to remain, which means you will be looking at small single-digit kind of growth numbers for profit for most of the companies, which are now trading at between 40 and 60 times forward earnings. It's a miracle that they still trade at that valuation.
Makes sense. I mean, although the only positive correlation here could be perhaps you could upgrade and move up in the value chain should, things become cheaper in the premium end of the FMCG curve. But Kunal, a non-starter, staples, you think, or is there some potential that these stocks could move up?
I think we are getting into that zone where maybe the near-term best at least could be out for many of these stocks. And I would actually expect a pause for many of the names. I think that's one of the reasons why in the last, 3-4 days, you've just seen a disconnect happening to the entire FMCG basket, whether it's likes of HUL, Marico, Britannia, etc. You've not seen any major participation, breakout, volume churn happening to these stocks. So I think in that context, I would actually expect that the sector would probably over the next, say, 3 to 5 trading sessions or the next 1 to 2 weeks, just about gets into a little bit more sideways price action.
All right, so that's the take coming in on the FMCG basket right now. But other than that, Ruchit, anything in particular that is looking good to you within the whole cap goods space? Because what I see is that companies like Siemens, ABB, Cummins, they are making very decent moves today.
Siemens has a positive chart structures. The stock has seen some consolidation over last 2 or 3 weeks. And today we have seen that the price is giving a breakout from this consolidation, that too accompanied by good volumes. If you look at today's daily volumes and compare it with the daily average volume of last few days, then definitely on this price up move, we have seen a very good volume action. So I think the stock has potential to rally towards 3,400 in the near term. So if anyone is looking for taking any fresh buying opportunities within the cap goods space, then Siemens looks that it could be an outperformer within the sector.
That's the take coming in on cap goods. But Anand, what is your own sense? Because with this entire fillip to consumption, which seems to be the government intention right now, it seems that perhaps capex could take a back seat. Or do you not think that's the right assumption?
I think the government is not doing this out of charity. They are doing it because they see a dramatic fall in consumption. So, there are two ways to look at it. One, you could argue that, oh, given this, consumption will go up. The other way is to say whatever you are forecasting is what will happen after the cut, because otherwise it was dropping. I tend to belong to the second camp, where I believe that if they had not done anything, you would have seen a sharp decline in consumption growth. And now perhaps that decline may not be so sharp, but even then, there is a lot of pressure in terms of cash flows with most households other than the top few. So I'm not a great believer that you will see a major consumption uptick. Yes, it may now stay where it was, or perhaps not fall, rather than actually show a decline. Now, in that space, obviously, at the highest end of the market, there is going to be growth, because that is one segment which has not been touched very much and where the income continues to grow. And therefore, luxury goods, etc., may continue. But for how long? That is not what sustains markets, or for that matter, industry.
All right, but other than that, one of the other pockets that is showing decent moves today is actually the telecom space. We did talk about one of the counters, that is Vodafone. Even Bharti Airtel is showing good moves, and within the cement pack as well, I see only Ultratech Cement that is holding on to decent gains. But we have seen, Kunal, that all these cement-related counters, they have already shown good moves in the past couple of months, and post monsoons the demand is also expected to pick up. But technically, is the stock price expected to go higher?
Yeah, it's expected to go higher. I think Ultratech Cement, Dalmia Bharat, these are names which have done reasonably well. Shree Cement, we don't discuss of the stock that often, except for that last phase of high volatility. The stock has done very well for themselves over the span of the last 6 months, 1 year. And you have to look at a longish term time frame when you're talking of cement names, because when you look at this in a 1 month chart window, they would look absolutely flat for the price trajectory. But then when you look at this in the context of the price trends, where the stocks bottom out 3-6 months back, and then how the price trends shape up, you will see a decisive trend shaping up, very slow, gradual for many of the cement names. So I'm of the belief that once the market gets into a further breakout zone or a momentum zone on the upside, cement stocks would do reasonably well. I think Ultratech Cement, even at current levels where the stock is trading right now, looks fair to be at least poised for at least another 5% to 7% upside over the next 1 to 3 months. You may look at Dalmia Bharat also. I think that's another name which has done reasonably well. I think if I'm not wrong, it's already perched at a fresh high around 2,400 plus mark. Continues to look attractive.
Okay, that's the take coming in on what the cement pack may be up to. Just looking at the market texture right now, Bandhan, Biocon, Cipla, Asian Paints, M&M. These are your key pressure points in trade. Of course, the list is much longer, but these are your key marquee names which are pressurizing the market. Of course, there's Titan, there's iShares, there's Infosys as well, which is down about almost 1% or so. Richard, just wanted to get your sense, because that rally which kick-started after Infi buyback didn't last too long. What is your reading on the charts for the IT pack? Anything that's looking good?
Yeah, so I think we have seen one round of pullback move in the many of the IT names post the announcement of the Infi buyback. But what is missing is a follow-up move, which has not been seen in most of the IT names. So I think one should read this just as a pullback move and not any start of a larger uptrend. Rather, this could result into the downtrend which was there in many of the IT names get converted into a consolidation or a sideways phase. So we believe that IT as a pack would undergo some sort of consolidation, and selective mid-cap IT names such as Mphasis, which has shown a good relative outperformance when the overall IT space was correcting, those can give a better return. So from the large cap space, we think that IT sector would go through some consolidation or a sideways price movement for a few weeks, whereas selective mid-cap IT stocks could show a good relative outperformance.
Right, okay, Ruchit, Anand, Kunal, we'll let you guys go on that note. Thanks as always for your time, and let me hand it over to Snehi to wrap up the market action for us.